the set of circumstances that surrounds me suggests to me that I need to own gold as an insurance policy against the set of circumstances that would take gold not marginally higher, not to some psychologically important $2,700 number, but some substantially materially important move like $7,000 or $8,000 or $9,000. I think that there's a high probability of profit. I own it because I think there's a possibility of truly extraordinary profit. It wouldn't surprise me that a 2.5% or 3% portfolio position, which is the approximate size of my allocation to junior silver stocks, could, in the 3 to 5 year time frame, constitute 25 to 30% of my overall portfolio.
Hello and welcome back to Soar Financially, where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the @JR Mining Guy on Twitter, the CEO of the Soar Financial Group, and of course, your host for this channel. I'm really looking forward to this discussion that we have lined up today because it's with recurring guest Rick Rule of Rule Investment Media. We've had Rick on a number of times on this channel now, but the last time was in early January during the Vancouver Resource Conference. We sat down in person and we chatted about, market developments, credit, debt, and the US in general. But it's time to catch up because a lot has happened. Gold has moved, copper has moved, silver has moved. Why has that happened? Why have they moved? We're going to talk about triggers, and of course, how is Rick benefiting from it? How is he investing? Is his book full? Is he still deploying capital? And of course, we're going to talk valuations, and then we're going to catch up about the Rule Symposium. We are a media partner, as you can see up there. I'm really excited about it because I'll be attending the event in person as well. I'm really looking forward to some fantastic interviews, and we're going to talk about what he envisions the event is going to be like. What are the main themes? Who should I interview? And we're going to talk about some of the living legends that will be attending this session. So really looking forward to this. Before I switch over to my guest, quick reminder, hit that subscribe button. We tremendously appreciate it. Leave a comment, leave a like, so other like-minded investors can see this video. Now, without much further ado, Rick, it is great to see you again. Thank you so much for joining me here on Soar Financially.
Pleasure to be back, Kai. Thank you for all of the work that you do in investor education. I'm proud to be part of it.
I appreciate it. No, thanks for that, Rick. And let's dive right in. Last time we chatted was about the end of January, before actually anything has happened really in our sector and in the commodity space, to be quite honest. Let's catch up on it. Like, gold has moved, silver has moved, copper has moved. The question is, what triggered it and why all of them at the same time, and where are things headed?
Well, I hate to dispute your assertion so early in the interview, but I would suggest that the move in gold began to take place in the middle part of the year 2000. Gold is now up from $250 an ounce to verging on 2,400, and in non-US dollar currencies is up substantially more. So I would argue that a longer-term perspective is needed. I will grant you that the rate of increase in the gold price has certainly been more dramatic in the last 2 years. But people who have owned gold for 2 decades, like myself, will note that gold has done its job. And I think the fact that it has done its job in US dollars and more than done its job in foreign currencies over the last 20 years has done as much as anything else to increase activity in gold. Now, the very recent move in gold is unusual in the sense that normally gold price escalation is a consequence of individual investors or retail hoarding. The last 2 years, with the exception of the last 7 weeks, have been marked by retail dishoarding. If you look at the statistics around the ETFs, physical metal ETFs, you will see that for 2 years, retail investors have been selling gold, while at the same time, the central banks have been buying. Whether or not the last 7 or 9 weeks, depending on how you count, have seen whether or not there has been a sea change in retail sentiment is a different question. But I would suggest to you, Kai, that gold and silver are probably just getting started as opposed to how to their moving. My suggestion is that while the retail investors have changed from sellers to net buyers, the net buyers relative to historic norms in gold bull markets are still extremely muted. And the incentives around central bank gold buying, which is to say the poor arithmetic around U.S. Treasury securities and the weaponization of the U.S. dollar, both through the confiscation of Russian assets in U.S. dollars and also the attempts of the U.S. government to apply hegemony on the SWIFT banking system, means that central bank buying continues. If you see retail buying overlaid on top of central bank buying, then I think you see a real move in the gold market.
Absolutely. No, like we're seeing, like I was a bit surprised personally by the violence of the move, as you said, like how it moved from like 2,000 to 2,400 rather quickly, which is a big move for a 5,000-year-old relic, right? Were you surprised by that, or was there so much pent up pressure that just released quickly?
Yeah, I think, Kai, in fairness, with regards to your relative youth, what you have seen is a move that in your standards is fairly violent. If you went like I did through the decade of the 70s, where the gold price would move, as an example, from $120 to $170 in fairly short order, the move that we saw in percentage terms was not particularly violent. Violent in the context of gold price moves since maybe 1982. But in a historical context, I would suggest not very violent at all. Now, I need to admit that I've experienced enough volatility in my life that I'm surprised by the lack of volatility across all markets. For the life of me, I don't understand why the VIX is so tame. But I guess even an old man learns new tricks. I need to say, too, Kai, that it's ironic, given that I'm so much older than you, that I have more patience. I have much less time on Earth. And it's not like I don't want to be rewarded quickly. It's just that I've learned that rewards take longer to accrue, much longer to accrue. I think I said on your show in January, I don't own gold because I think it might go from 2,400 to 2,750. That doesn't interest me at all. I own gold because I'm afraid it's going to go to 7,000 or 8,000 or 9,000. And when I say afraid, I really mean that. The circumstance that takes gold to 9,000 US dollars is invariably a very unpleasant circumstance and would devastate other parts of my portfolio and usher in, I think, a much more challenging lifestyle. At my age, I don't want a challenging lifestyle. However, the set of circumstances that surrounds me suggests to me that I need to own gold as an insurance policy against the set of circumstances that would take gold not marginally higher, not to some psychologically important $2,700 number, but some substantially materially important move like $7,000 or $8,000 or $9,000.
Now you're teasing me with YouTube titles there, Rick. You know, now you're giving me numbers I can use. But to follow up there, like, you know, you mentioned the mid 2000s gold at $250. Now we're at 24 or 23.50 as to today. In that context, is gold perceived expensive now? Like, let's put that a bit in context, because if I just look at the price, right, and I see 2,300, would you say that is expensive? And by the way, like in New Orleans at the conference, I think we've seen each other there as well. I've spoken to one of the bullion dealers, and they said, well, investors are selling gold right now, or not investors, sorry, like bullion owners are selling gold right now to cover some expenses, because over 2,000, it is perceived expensive and a good sell maybe at that time. So putting that into context a little bit, is gold expensive?
I don't think so at all. You know, the price in US dollars is in a sense a floating abstraction, because the US dollar is a very useful floating abstraction. I would note, too, that financial assets are frequently, in economic terms, so-called Geffen goods, which is to say that the price escalation in gold and other commodities, frankly, validates the narrative thesis that causes people to be interested in them. My suggestion to you with regards to disintermediation or selling by gold holders has to do with the fact that a lot of the gold holders are my age. Gold has done the job for them, and they are reaching the point in time in their career where they are beginning to liquidate some investments in favor of income-generating investments because they need the income. I don't want to sound too unhumble, but I don't need the income. What I personally want is the insurance against economic disruption in fiat-denominated savings and investment instruments. So for me, gold is an important and frankly growing part of my own portfolio.
Rick, I'm almost embarrassed to ask that question because it's a bit cliche, but it's one that just popped into my head based on what you've been saying. But if we substitute, or not even substitute, we're not even managing to substitute, older investors and owners of bullion and gold with, how do we substitute the older generation for the younger? Because it doesn't seem to be happening. It's a cliche question. How do you attract younger investors into gold?
Kai, I think it's happening very rapidly. As you know, I have a fairly active social media presence. I established that presence back when I was at Sprott as a way to communicate with the existing gold community without having to deal with bottlenecks in conventional media who didn't want to talk about what I wanted to talk about. When I began to engage with investors on social media, I found that there was a whole generation of younger investors that I hadn't known how to reach before. Through social media, I reach them now. I'm delighted to tell you that my own proprietary database, in terms of new subscribers, is marked by having at least 50% of them under 50 years of age. And by the way, having 35% of them is female. There is a global audience for gold. My subscriber base now comes, at last time I checked, from 39 countries. And in fact, new entrants to the database is more non-US than US. That includes, of course, Canada, which is, geographically and I would suggest temperamentally fairly close to the US relative to some of the other countries in the database. But I think the circumstance that you're talking about is already occurring. We don't see it, perhaps because we hang out in a gold subset, which is to say the junior miners. And the buying that you've seen in bullion hasn't translated to the junior miners for a very simple reason. The gold buyers have been central banks, and central banks don't buy, for very good reason, penny mining stocks. When people are suggesting that there's been a huge flow into gold, but no flow into gold stocks, and they've been scratching their head for a reason, I think they've been talking to the same coffee group for too long. The buyers for gold right now are foreign central banks, and they don't buy gold stocks. I mean, this is really simple stuff.
Rick, we got to talk off air how you're attracting the female audience to your channel and social media and database, because we're reaching about 10% here on our YouTube channel. So if you got some tips, tricks, and ideas, let me know, because
I don't think that they're attracted to a 71-year-old icon. I suspect it has to do with ideas.
Okay, maybe we'll have to share some of those. We have to get to that, because that's a nut I'm still trying to crack, and it's puzzling. It's interesting to look at the statistics in the back end of our YouTube channel and who we are attracting. So you gave me a couple ideas to follow up on what you mentioned here, and maybe we'll I'm trying to structure this. I love this conversation because it's flowing, but central banks buying junior mining stocks is, of course, a ridiculous suggestion, but we've heard another suggestion the other day, and I'm not saying it's ridiculous, but it's a suggestion that Canadian pension funds should be buying junior mining stocks. And just want to jump down that rabbit hole for a minute because it fits in what you mentioned before we talk about the other commodities. But what are your thoughts on that?
That's maybe one of the dumbest ideas ever hatched in Canada. I think that Canadians traditionally have been fairly good investors. And the idea that the government or some other entity should tell Canadians what to do with their retirement dollars is, I think, the height of absurdity. The wealth in Canada came about as a consequence of private enterprise and private investments. You're going to let, in effect, the CBC or the Canadian healthcare system be responsible for the retirement of Canadians? I think this is an absurdity. I think when the Canadian mining sector begins to perform for investors, they won't need to loot people's private pensions.
No, I fully agree there. It's an interesting concept. I do agree. Like, the one concept I get is invest domestically. I do get that. Although as a mining sector, we don't need to.
Why?
Like they need to chase returns, right? It's like,
why don't they focus on making Canada globally competitive? Then they wouldn't have to force anybody to invest in anything. The prime minister up there has been in the cold too long. The idea that he says that there's no business case for Canadian natural gas, when all of his trading partners are interested, tells me that if you want to get people to invest domestically in Canada, you make Canada a good place to invest. This is simple stuff. You set about wrecking the country, and then you try to force people to invest in it. This guy's as dumb as our president. I mean, that takes real skill.
well, he told Germany off when we asked for some natural gas recently. Oh, last 2 years. So, like,
Sent the
why?
Koreans packing, sent the Japanese packing, sent the Chinese packing. The only person, I mean, I guess the reason he says that there's no business case for Canadian natural gas is he won't let it happen. And then he says that more people should invest domestically. I mean, he is the guy who legalized marijuana. It must have been for a reason.
I guess so. Yeah. No, let's appreciate you humoring me, like asking that and answering that question, because I want to come back to silver and the other
Great.
commodities. Copper is a bigger topic. I want to talk silver first. It has been lacking gold. Now it's leading gold on the down, what do you call it? Like on the decline, because it below $30 as we're speaking, pretty much. So, of course, I'm not asking for daily commentary on the silver price, but we need to talk about the silver price action. And I've recently had Chen Lin here on the channel. He called for $50 silver in June, and the reason is like simple: solar demand out of China is way higher than like the Silver Institute predicts. So I'm curious, like, where do you rank silver and in respect to gold? Because it seems like it's tracking gold still quite closely.
My experience has been that a precious metals bull market is initially led by gold. The first adherents to the narrative, the precious metals narrative, are fear buyers. And so the momentum has to be established by gold. My experience again tells me that once that momentum has been established, perhaps because of the lower unit cost, that silver takes over and begins to move further and faster. Are we far enough along in a gold bull market that silver catches fire? In our last interview, I said it would probably take a year or 18 months. That took place in January. Maybe all things are moving faster now. I don't know. And I don't know why silver outpaces gold, frankly. I've thought an awful lot about that. But I do know, looking at past major markets and small rebound markets, that gold leads the market and then silver takes over leadership. And when silver takes over leadership, it moves further and faster. I know, too, that the combined market cap of the real silver stocks, I don't mean the people that have silver as a component on the name of the company in the share certificate, but rather companies that have some silver. That's the most volatile sector of all. The combined market capitalizations, the silo, if you will, of silver juniors is so constrained that when, as and if, the generalist money comes into the space, as Doug Casey puts it, it's like siphoning Hoover Dam through a garden hose. And we began to see some pretty interesting moves in the higher quality silver juniors in the last 3 months. Is this break up, if you will, break out in silver real? I don't know. I absolutely don't know.
It's puzzling. The price action is puzzling me a little bit because we were below $30 again, and I saw 30 maybe potentially as a support line because it was that big wall to climb. Now we jumped over it, and now it seems like we fell off of it again. So I'm curious. I'm not a technical analyst, so
yeah, I think again the difficulty that you and I have in this discussion is both materiality and age. I don't particularly care what happens week to week. I really don't. I don't watch the silver price week to week. I just don't. And I'm not interested in trading or psychological support at $30. I own silver because in my experience, when gold really moves, silver really, really moves. A larger part of my portfolio is denominated in gold, because I'm older. I own it as an insurance asset, but I have been in 4 different markets where silver materially outperformed gold. So I do have a speculative position, more heavily geared to the silver stocks than to silver. I own it not because I think that there's a high probability of profit. I own it because I think there's a possibility of truly extraordinary profit. It wouldn't surprise me that a 2.5% or 3% portfolio position, which is the approximate size of my allocation to junior silver stocks, could, in the 3 to 5 year time frame, constitute 25 to 30% of my overall portfolio. That's why I do that. I'm not saying it's a probability. I'm not saying it's going to occur. I'm saying that based on my past experiences, that there is enough of a possibility of a tenfold increase in a portfolio of high quality silver stocks. And because I can afford the risk, both financially and psychologically, I'm in that place. When I have this discussion with some younger people, what I find out is that they bought the silver narrative so completely that they have 50% of their portfolio in junior silver stocks. And I think that's an insanity, a true insanity. Maybe not if they're officers and directors of small silver mining companies. In other words, if they're investing in themselves. But passive investors, particularly young passive investors, who need fairly balanced portfolios, who need compounding and time on their side, shouldn't over-allocate to any speculative asset.
No, fully agree on the silver side here. Rick, do you look at the supply and demand dynamics at all when you look at silver and other commodities?
Other commodities, yes. Silver is very difficult. There was a point in time, I think it was in university, which is to say 50 years ago, when I thought that the silver market was probably knowable. I've decided it's not. Primary silver production, which is to say silver from silver mines, my understanding is that that contributes 16 or 17% of new supply. Recycling is much larger. And of course, byproduct production from gold mines, copper mines, lead mines, and zinc mines are important. What that means is that the silver price could double and it wouldn't necessarily increase supply. You would need to look at investment and production trends in, as an example, copper, lead, and zinc. You would also need to look at recycling technologies around recovering silver from solar installations or water installations. So it's very difficult to understand supply. The second part of supply that's difficult is that most of the silver that's ever been mined is still supply. While a lot of it has been used in photography and other commercial applications, a lot of that has been recycled. Lots of silver remains in private hands, including private hands in places like Bangladesh, India, Pakistan, and Sri Lanka. People who own it because they're afraid of their government and are unlikely to dispose of it or disclose it until the need arises. So it's very, very difficult to understand the supply side of silver. With regards to demand, a reasonable and growing amount of demand is industrial, but silver is at once an industrial material, subject to economic flows, and a monetary metal, which means that an important part of demand in the near term has to do with its speculative or investment demand. The consequence of that is that while I look at supply demand in commodities where I think that that's understandable, let's say oil and gas, let's say copper, let's say coal, let's even say lithium, a metal that is as strange as silver, particularly strange given the relatively large size of that market relative to some other metals market, is one where those calculations are very, very difficult.
If you were to give it a percentage, monetary use versus industrial use, where would you stand right now on silver? Like, what corner would you put it in percentage-wise?
I don't know. I think in terms of near-term price escalation, it's all about monetary use. All about monetary use.
No, I appreciate that because I want to talk copper real quick before I have a couple follow-up questions on like U.S. economy, world global recession, and things like that. I think that ties it all together. But we got to talk copper first because I mentioned other commodities in my opening in my question there about silver and the supply-demand dynamics. And we've recently seen BHP make an offer for Anglo, and it was all about copper. It was an interesting signal to the market because I believe the copper price jumped about 30 cents a pound when that deal was announced. It was pretty much shining a light on maybe the fundamentals of supply and demand fundamentals in particular. Where do you stand on copper? Like, let's summarize the copper market a little bit, and what are you taking away from that proposed and now failed merger?
Well, Kai, you put your finger right on the pulse. It is pretty obvious to the big copper producers, the people who control supply, that we have a supply cliff coming. We and they have underinvested in copper for 3 decades. Meanwhile, the global economy has grown. No matter what we do, absent a sort of a synchronized global recession or depression, we will experience much tighter copper supplies and probably much higher copper prices over the next 5 years. Will that occur in 2024? I don't know. Will it occur in 2025? I don't know. To be honest with you, Kai, I don't care. We have a circumstance where supply shortages are inevitable. The price doesn't have to go up in the early part of a supply shortage if you have a recession. If you reduce demand simultaneously with reducing supply, it doesn't necessarily have to have an impact on price. But the truth is that I think if we have a recession, after the recession, copper demand continues to increase for some fairly simple reasons. The world is electrifying. The way you generate electricity, the way you transport electricity, the way that you utilize electricity is all about copper. And it's not just electric vehicles and batteries. It's also about the fact that 1 billion people on Earth have no access to primary electricity. Over the next 20 years, they're going to get it. Another 2 billion people on Earth have access to only intermittent or unaffordable electricity. And that's something that the human race is going to address over the next 20 or 30 years. And that takes a ton of copper. Meanwhile, because we've underinvested in copper for 30 years, and because copper takes a lot of time and a lot of money to discover, and then permit, and then finance, and then build, there is an inescapable sense that over the next 5 years, we're going to have supply deficits in copper. Let's look at one deposit, the Resolution deposit, a giant deposit in anybody's eyes. Now well over 1 billion tons of 1.5% copper. To put that in context, that's 3 times the average mine grade worldwide. That deposit was discovered 30 years ago. It's been in permitting for 25 years. There's probably another 5 years to go in permitting. Then after that, there's probably 5 years to go in mine construction, which is to say a wonderfully located asset in Arizona, allegedly a politically safe jurisdiction. Wonderful, wonderful infrastructure. Towns nearby that have copper miners in them. Power, water, rail, road, everything perfect. 30 years in permitting. And this story goes on and on and on. There's also political challenges around copper, other political challenges. Cobre Panama, the Panamanian government stealing a copper mine after a $10 billion capital allocation to it. There is no doubt in my mind that we will face supply shortages in copper. The other thing I like about copper is that it often occurs in big mines. You've heard me say before, Kai, small mines can make you small money, big mines can make you big money. Small mines have big risks and big mines have big risks. I'd rather take big risks for big money. There's any number of copper mines in the world that generate well over $1 million a day, pardon me, in free cash. When you make a big copper discovery, you get paid the way we got paid at NGEX. You get paid the way we got paid in Ivanhoe. You know, you get really, really, really paid. And in our business, you take big risks. Your big rewards have to amortize more numerous failures. And that's about copper.
Rick, I love our discussion because my mind is spinning because I'm not sure where to take this next. But I do have one last macro question. I'm trying to squeeze it in before we talk the miners, mining tycoons, which is the big miners, big money sort of discussion, which would have been the perfect segue. But I still want to squeeze that macro question in there. And that is the question about the development of the copper and to a degree the silver price, because I think you've answered that question already. If a recession actually hits, because if I'm looking at Dr. Copper right now, it is telling me that a recession is not happening. It is predicting maybe a bit of economic recovery. There was a bit of a copper squeeze, in my opinion, but the price levels are still elevated. So I'm curious, what is your takeaway from the price action by Dr. Copper?
I think what you're saying is probably true. I need to say, Kai, that your focus and the mining industry's focus is on the fairly short term. What's going to happen in the next 12 to 18 months? I used to be interested in that, but I've noticed that my short-term price forecasting track record is unblemished by success. I've noticed, too, that my performance is just about average, which is to say the industry's track record is unblemished by success. I don't want to sound, I don't know, cynical, but
You're in junior mining after all.
Yeah, I mean, I don't really care what the copper price is telling me about the probability of recession in the next 12 to 18 months. I don't think the copper price knows. I don't think anybody knows. I don't think that anybody can forecast black swans, exogenous shocks. I don't know if there's going to be a recession. What I know is that I'm a fairly healthy 71-year-old. And I'm going to be alive and investing and spending and saving on the backside of that recession. That I know for sure. I know that 1 billion people on Earth have no access to primary electricity. I know that for sure. Do I know if copper is going to go to $5 or $3 first? Nope. Don't know. Don't care.
Oh no, appreciate that. Thanks for the clarity there on that, Rick. No, it's it's of course part of the what do you call it, the educational process here on the channel. We're trying to read the tea leaves a little bit, right, and trying to predict the future.
There are people who are good at trading. There are other people who aren't good at trading but are interested in it. God bless them.
I keep making the joke. Sorry to jump in there, Rick, but I keep making the joke. I've been 21 years with my wife, and I'm a horrible trader. So not sure what that tells you about what that tells you about myself. But I'm definitely not a trader either.
Right.
So, Rick, perfect segue. Big mines, big money. I was going to ask you about Mining Tycoons, and I threw up a chart, and I think I've stole it from Luc Ten Have on Twitter. I forgot to write down the source of it, but. If you follow the Mining Tycoons, the Lundins, the Pierre Lassondes, they mostly make their money in gold and copper.
Yep.
And I want to analyze that just a little bit. It's not they've made their money in helium, because I think it's Ian Telfer has put some money into helium, and he's down by 75% right now, at least right now, right? Let's analyze that a little bit. Is it because they bet big on big mines and big cash flow? Is that because they're the Mining Tycoons now and they didn't care about the little stuff?
I think two different reasons. Your cost of capital is always lower in the gold business. People pay more for gold-free cash flow than they do any other mineral commodities free cash flow. So your cost of capital is always lower. Copper is very different. When you make a copper discovery, it is a great, big, and highly economic deposit. If you look at the free cash flow as a percentage of capital employed in the copper business and the gold business, all other things being equal, you'd never go into the gold business. The copper business is a better business, measured by return on capital employed, measured by operating margin. Pick a measurement. But the gold business has a lower cost of capital. It is not unusual in a good market for senior gold miners to be trading at 3 times net present value. Trading at 3 times net present value in an industry where your deposits are constantly declining means that your cost of equity capital is actually sub-zero. Intelligent entrepreneurs like the idea that their cost of capital is actually sub-zero. So I think that's the reason for those two things. The fact that Ian Telfer may be down 75% on the helium business means I better start looking at helium. I like circumstances where the outlook as a consequence of its recent performance is so poor that the industry is in liquidation. So I guess that tells me I have to start looking at helium.
Rick, I tried to make the perfect segue to your conference, which is the Living Legends panel. That was my segue. That was my gateway to talk about the conference here on this. But now I got to squeeze in one last question, and that is like unloved commodities that you're looking at right now. Helium might be one, but we talked gold, silver, copper.
Helium.
But
I don't know enough about helium to look to mention it. I am looking at sulfide nickel deposits. The nickel price has been clobbered, absolutely clobbered, partially because it got too high, but more particularly because of lateritic nickel production in Indonesia and the Philippines. So I'm looking at sulfide nickel deposits. I'm looking particularly at platinum and palladium, which is to say non-South African, non-Russian platinum palladium. There's not much to look for, but that's certainly a commodity that's absolutely hated. The commodity that I think is really, really, really going to attract my attention in 2026 and 2027 will be lithium. Lithium was an investor's favorite. We never had a shortage of elemental lithium. We had a shortage of lithium refining capacity. The lithium price went up 5-fold or 6-fold. Everybody in the world started looking for lithium, and lo and behold, we started looking for it. We found it. Now we have an oversupply of elemental lithium at the same time that we've debottlenecked the processing. There is no hate as sincere as the hate of a jilted lover. And there's probably 500,000 people who've lost fairly large sums of money on lithium. My suspicion is that you'll see a turnaround in that market, 2026, 2027. You'll see the rationalization of those discoveries which are economic at lower prices. And you will see the type of investor hate around lithium that you saw around uranium and silver after they disappointed investors. That isn't a theme for 2024, but it's definitely a theme for 2026. So I'm beginning to spend a lot of money right now understanding the higher quality undeveloped lithium deposits, where distress might develop, and how an old guy like myself may be able to take advantage of that circumstance.
No, fantastic. That is an interesting. Lithium, like, it was easy to predict that there was going to be an oversupply, but in that space, in my opinion, that's why I stayed away from it. And I personally don't understand enough of lithium.
2022, Kai, when the lithium boom was in its absolute craziest frenzy, the annual report of SQM, the second largest lithium producer in the world, said that at current lithium prices and demand rates, that they had 85 years of reserves. Does this feel like a shortage?
Like, how many new lithium mines do you need?
They had to build more lithium refining capacity. They were doing it. Albemarle was doing it. The Chinese were doing it. On top of that, you had a lot of investment by some fairly smart guys, Berkshire Hathaway, Warren Buffett, ExxonMobil, around direct lithium extraction. I go back to an earlier interview that I did with you, where I tried to say, the cure for high prices is always high prices. The cure for low prices is always low prices. When the price of lithium went up 6-fold, that was the beginning of the cure for the high price. Now that the lithium price is off 75%, if you assume it could fall as much as 50% from here, the cure for those low prices will be low prices. You'll shut in marginal production. You'll have no incentive to look for other materials to substitute for lithium. You'll have no incentive to develop fabrication technologies that use lithium more efficiently because it'll be too cheap. As I say, this is a theme that you're going to have to study now so that you can employ it in 2026, 2027. But it's a theme that's going to make a lot of money.
Talking about too cheap, humor me, Rick. Let's talk mining stock sentiment, junior mining stock sentiment for a little bit. And we talked about it in January. You said there'd be a lot of money to be deployed in the junior mining space. Personally, I haven't seen it yet. And By that, I mean the coverage space that we look at Oren Inc. It's companies below $1.5 billion and financings below $100 million. So that takes out the producers like the Hudbays that raised $300 million. There is money available for those companies, don't get me wrong, but it doesn't seem to be available for the juniors yet. We've had a really slow start, only $1.3 billion raised by May 15th, May 20th. So very small number. Keeping in mind, we raised $4.6 billion last year overall in our coverage universe, which was actually a substantial amount of money. But we've been off to a slow start despite higher commodity prices. How do you gauge sentiment right now, Rick?
I think sentiment's excellent. I think probably 10% of the population of junior miners are investable. I think 90% of them should go to their intrinsic value, which is zero. I noticed that for the last 18 months, probably 80% of the financings that I've participated in or tried to participate in were oversubscribed, and I was cut back. When people tell me there's no money available for juniors, there's no money available for junk juniors. Recently, I tried to get in the Wiesla financing. They didn't let me in. I tried to get in the Kennerland financing. They had industry partners, which is to say major mining companies and commodity finance houses that were allowed in. Living, breathing human beings, even fairly well-known ones who write stout checks like me, weren't allowed in. Now, pardon my bad use of English, but consolidated shitbox, yeah, they're not going to be able to finance. They shouldn't be able to finance. No. We talked before, Kai, about a study we did years ago where the median TSXV junior that we studied in our database had general administrative expense that exceeded their exploration expense. Why would anybody fund that? I think we're in a market that is optimal. The best companies have been discredited by the rest so that you can buy them at reasonable terms and conditions. They're doing good work. They have access to capital. I wish the terms were better. I wish that the financings were being done at greater discounts, or alternatively, that they were more generous, offering me warrants. I think the fact that the financings are increasingly led either by commodity users or by major mining companies, which is to say sophisticated investors, is a measure of the health of the market. I love the fact that some of my former colleagues in the brokerage business who used to make their money allowing punk hedge funds to strip warrants in financings for worthless companies are having a difficult time hanging that bogus paper. I think that's an absolutely splendid turn of events.
You mentioned in January, there's really good pricing and an audience, you meant yourself in that regard, is willing to take advantage of that pricing, right?
Yep.
It seems like your mood has changed a little bit again since January. Seems like prices have either moved away from you or terms are not as generous anymore. So I'm curious, can you elaborate on that a little bit?
Yeah, I've had better access to product in the aftermarket. That is to say, if companies are out of favor, particularly if they've done a financing and then sold off after the financing because they used up all of the potential buyers, I found that I'm able to fill my boots often in the aftermarket. If they're not going to give me a warrant in the financing, why would I accept restricted stock? It makes absolutely no sense. So I've been able to be pretty effective in the aftermarket for these companies, which is great because I've been much less successful than I would like to have been in the private placement market, simply given the fact that some of the private placements are going off on terms that I think are unreasonable from a check writer's perspective, and others where I find the transaction favorable. The company is going out to raise $20 million, soft circling $60 million, and cutting everybody back.
Oh, interesting. I appreciate you sharing that because I've been witnessing a few trend changes there as well. So curious to keep tabs on that and the quality of companies as well. Rick, I don't want to take up much more of your time. We got to talk about the Rule Symposium. I was going to talk about being a US shareholder and the blowback and how difficult it is to invest in Canadian mining stocks and how unnecessarily high the hurdles are. But I want to come back to the mining tycoon discussion because I really like that one. And it's a discussion I've often had with other investors and other people like yourself in this space. It's like you're hosting a Living Legends panel at the World Symposium. And I really like that one because I keep thinking about it, like who will be on that panel? If you were to organize that panel in 15, 20 years time, who would you invite on that panel, Rick? And I really like that discussion.
I've thought about that, and not at the 24 symposium, but the 2025 symposium. I'm going to expand the format. We will have the Living Legends because it's always the most popular panel we have. But we're also going to have financial legends where we have the best financiers in the mining space, not just the company builders, but rather the investors. And in addition to that, we are soliciting nominations from the industry for a Future Legends panel, where we attempt to do precisely what you're discussing. Financiers, explorationists, people who we think will be the Ross Beatties and the Lucas Lundins and the Bob Quartermains and the Robert Friedlands 10 years or 15 years from now. I have some ideas, but I'm actually soliciting nominations for that through the subscribers of the Mining Journal, with whom I have a conference joint venture.
Any favorites? Like anything you want to share? I've got to poke you a little bit to get some names out of you because
certainly on the exploration side, although he's been around for a long time, Brian Dalton from Altius comes to mind. Zach Flood on the exploration side is a personal favorite of mine. Time will tell if he can, bring in a second major discovery. I think on the financiers side, you need to look at Amir Adnani. He has built a multi-billion-dollar company stable from scratch. A great contrarian investor. He bought gold assets when they were deeply out of favor. He's monetizing them now. I think you need to look to him. There's a very, very, very impressive cast, and it'll be interesting to look at how they deal with this upcoming bull market. I'm attracted to Nolan Watson. He made some serious mistakes in his career, serious mistakes. So he's been tarnished. And I don't think that Nolan's going to repeat those mistakes. People who know me back to the period 1977 to 1982 will note that I made some fairly serious mistakes in my career too. They've served me and investors who have hung out with me well since then. There's a lot of them out there. I'm going to be spending more time in Australia this year. So I look forward, because they've had a much more vibrant junior sector for the last 5 years. I'm looking forward to gathering data about the future legends in Australia. The past legends, the Robert de Crepneys, the Owen Haggertys, they're fairly well known. But the idea that there are future Ross Beatties and future Bob Quartermains out there at these conferences right now is appealing to me. And we will, as I say, we will be soliciting nominations for that via the subscribers of the Mining Journal.
No, that'll be interesting. That's definitely a topic I'm going to follow very closely there, Rick. But back to your conference, the Living Legends panel. What are you trying to squeeze out of them this time? Like, what's the focus going to be of the conversation?
The Living Legends is all about investor education. I want to talk to somebody about how they built a multi-billion-dollar mining company from scratch, how they found the market niche, how they chose the commodity, how they raised the financing, what mistakes that they make. Not so much necessarily for the history of the company, but more as a lesson for investors. I ask the legends, what did you learn that makes you a better investor today? What is it that investors on the street need to know about building a major, a multi-billion-dollar mining company from scratch that can allow them to identify $100 million market cap that's going to be a $2 billion market cap? In other words, how do people get early warning as to what's going to be a 10-bagger? I also love to ask these guys, tell me 2 or 3 stocks that you own today that you don't run what are other people invested in or doing that you're willing to invest in. Now, sometimes, they say, well, I'm still bidding. It's none of your business. I'm not going to tell you, which is fine. I had somebody email me 4 years ago about my conference, maybe 5 years ago now, and say that following Robert Friedland around my exhibit floor, watching what companies he stopped in front of, what booths he stopped in front of, and occasionally being able to listen to the questions that he asked, was worth the whole cost of admission, that they got the whole rest of the conference for free. And I think that's important, coming to the conference and not just listening to the speeches, but going on the boat cruise, sharing a cocktail with a Clive Johnson or a Bob Quartermain or something like that, watching how they interact, listening to the questions that they're asked in the Q&A period, including questions from industry professionals, is really, really, really worthwhile.
100%. And you've got some excellent macro speakers there attending as well. I'm really looking forward to it. And that's the selfish me speaking, because we're media partners. I get to interview them all at your event, and you bring them all to one location for me, Rick. So I truly appreciate that. But how are you going to combine the macro with the micro at your event? Like, how are you going to bridge that?
The idea is that our macro speakers present a worldview that we think is accurate and proven, but a worldview that you don't see on NBC or ABC or the BBC. Certainly what Jim Rickards has to say about Wall Street, having been, as an example, chief counsel at long-term capital management, almost bringing Wall Street down, is a useful message that you don't hear elsewhere. What Daniela DiMartino Booth or Nomi Prinz have to say about the Fed and Wall Street respectively, given their experience there, is very useful. And it's not the kind of thing that you see in the Wall Street Journal or on ABC. After you've absorbed that worldview, a worldview as the world is, not as the way the big thinkers would like it to be, then we present to you natural resources portfolio managers and analysts, people who have been successful in resources for 3 decades, not folks who failed at tech, and came down to natural resources so they could do more damage in some place that they weren't well known, but people who used the macro point of view that we describe to make money in natural resources. And then, most importantly, every single public company exhibitor on our floor has been vetted. We have to own shares in those companies before we permit them to exhibit. At other conferences around the world, the requirement to exhibit is simply a check that cashes. In this case, they've cashed my checks. It's a very different relationship. Now, there's no guarantee, Kai, as you know, that because I own a stock, it goes up, but there is a guarantee that the process is honest. Our attendees have been telling me for 28 years that the exhibitors are content too. The attendees own the conference. So if that's what they say, that's what is. The promise as a consequence of all that is that whether you attend that conference live, which is what I would prefer, or via live stream from the comfort and convenience of your own home, if you don't feel that I have delivered a conference experience that is worth your tuition, email me. I'll give you your money back. Complete gold-plated, no hassle, no BS, money-back guarantee. I've put on good enough conferences for 28 years. I've had to refund less than 1/10 of 1% of my tuitions. But that notwithstanding, if the combination of macro analysts, living legends, exhibitors isn't sufficient, that you believe that you didn't get your money's worth, I'll give it back to you. It's important to note too, Kai, we're going to give people 60 hours of intensive programming over 4 days, more than they can possibly absorb over 4 days.
Yeah, I saw the agenda, Rick. It starts at 7 a.m. Like, yep. Come on.
We're going to work people. And the consequence of that is that the whole proceedings, including the breakout sessions, are going to be recorded. And you're going to have access to those recordings for a long time. And you're going to need it. I put on the conference last year, and I had to watch most of the conference proceedings 3 times. If I had to do it, think about what somebody who has a life is going to have to do. So I really look forward to it. I not so humbly believe that all things considered, this is the finest natural resource conference on the planet, which is why I can get away with a gold-plated money-back guarantee. Come, be satisfied. If you're not satisfied, don't pay.
No, it sounds fantastic, Rick. I'm really looking forward to attending and being there in person, and already packed my bathing suit and my shorts. So really looking forward to it. And
for people who want to come, by the way, physically, we have expanded our room block 2 times. If you're going to come, the resort is truly spectacular, and it's really cheap. Those rooms sell in prime season for $1,200 a night. I think we're turning them, including the resort fee, for $330. But if we run out of room and you want to come, you're going to have to stay somewhere else. So if you're thinking about doing it, get in the room block, and get in the room block now. The second thing is that there's an added feature to the conference, which is the boat cruise. For 20-something years, we've been doing these social boat cruises as an adjunct to the conference. Space is always limited. People always put off trying to get on the boat cruise till the last minute. They're always disappointed. Don't be disappointed.
No, fantastic. Rick, it sounds like somebody's trying to get a hold of you here. Yep. And taken up way too much of your time. Tremendously appreciate our conversation. Can't wait to see you in person July 5th here. July 5th is my flight. I'll see you July the 7th latest. So really looking forward to it, Rick. And all the best organizing the last few days here. And I'll see you in Boca Raton. Thank you so much for your time. I'm going to let you go.
I look forward to it. Thank you.
Awesome. Good to see you. Take care. Everybody else, thank you so much for tuning in here to Soar Financially. I hope you really enjoyed this conversation as much as I did. Always fun talking with Rick. Lots of different conversation, avenues we could have taken here in this conversation. Really looking forward to seeing a lot of the subscribers of the channel and a lot of Rick's followers in Boca Raton here very shortly, in a few short weeks, just 3 weeks, 4 weeks, 4 weeks from now. And please, you'll find a sign-up link down below. It is an affiliate link, but make sure to check it out. The lineup is fantastic. I'm really looking forward to it. Really excited to be a media partner. Never spoke with Naomi Prince before, so I'm really looking forward to that conversation. Reconnecting with Danielle DiMartino Booth and a lot of the other speakers Rick has mentioned. Really looking forward to that. Thank you so much for joining us here on Soar Financially. We'll be back with lots more, and of course, we'll be back with lots of coverage from Boca Raton. Thank you so much.